going to go over today 6 ways to where you can lower your taxable income, but I'm going to actually give you a bonus one, which is number 7. I want to know if anybody's going to figure that one out after we go over the top 6 here. So let's just get right into it here and go over these 6 ways that you can lower your taxable income here. So let me go ahead here and share our screen, and then we're going to get excited and get you going here for ways that you can lower your taxable income. All right. So before we do that, just as a reminder here, I want you guys to mark your calendar for this Thursday at 6 o'clock. I'm sorry, at 7 o'clock p.m. This Thursday, we're going to have Ebony Ferguson. She's a mortgage broker. She will be coming to us this Thursday at 7 p.m. And she's going to be discussing ways that you could buy your first home or buy your investment property. She's going to be giving us from a mortgage broker viewpoint, how to go and get a HELOC, how to go and get a cash out refinance. What are the rates currently right about now? So we want to take advantage of this opportunity from actually having someone on the other side when we're going to apply for a real estate loan, what that looks like and how to prepare us for now as interest rates is getting ready to go down. So mark this date as well. September the 18th is when the Federal Reserve is going to announce when they're going to lower or how much they're going to lower interest rates. So this is going to be a spot on class with Ebony coming over to us based out of North Carolina, but she writes mortgages in many, many different states here. So this Thursday coming up, I want you guys to also be here live for this class as well. And so we're going to get right into it. All right. So guys, let's talk about this here. Federal withholdings is one way where people get into trouble when it comes to their particular taxes. Now, we do taxes as well. And one thing that we noticed last year was there was not enough people that actually had to pay back to Uncle Sam. They didn't have enough federal withholdings coming out their paycheck. And so one of the things that I recommend, and that's why I want to come to you guys now and share this here with you, right, is you could adjust your W-4. Now, oftentimes we don't necessarily, only time we adjust our W-4 is when we start a job. All right. But guys, you can go and adjust your W-4 anytime you want. All right. Now, I want to go over here briefly, just real quick here, how we can actually adjust our W-4 in order to have federal withholdings, more federal withholdings to come out. All right. Now, this W-4 here, this is a 2024 form here. It has significantly changed because back in the day, you could put like 0 and have the most taken out. But right now, this W-4 here, right, you put in your name, your personal information up here, whether you're single or married. All right. This seriously, if you have multiple jobs or a spouse that works, you'll mark it here. But the most important piece right here, right, is if you have dependents. So if your total income will be $200,000 or less, all right. So for every dependent that you have here, if you got 2 kids, you need to be marking 4,000 right here. If you got 3 kids, you need to be marking 6,000. If you got 1 kid, you need to do 2,000, right? So how many other dependents you have times this 2,000 right here, all right? Now here's another thing right here in step 4. You see this extra withholding right here? You can go in right here and for each particular pay period. So let's say, for instance, you owe, say, I don't know, say $2,000 last year. So instead of having to pay $2,000 all at once, you can go right here to the extra withholding. And if you get paid 24 times a year, now you can have $100 coming out per pay period for the extra withholdings in itself here. Now, but I'm getting ready to show you some ways where you don't necessarily have to do the extra withholding if you don't have to necessarily. But most people, they don't have enough federal withholdings coming out. And then most people, they don't necessarily know some of these methods. So what I'm about to show you is to help you lower your taxable income. See, the thing about it is, guys, we want to be able to make money, but at the same time, we want to be able to know the tax law and the tax rule to be able to shelter the money to where Uncle Sam and the U.S. government, where they can't necessarily have access to this money, taxable. So we want to shelter it into tax shelter accounts to where it's actually grows for us. We pay ourselves the money grows tax-free and we're not paying taxes on it. All right. So let's get back over here into it. Now, the W-4 here, that was one thing that we can do as far as go and adjust our W-4 here. All right. So 6 ways to lower your taxable income and to keep Uncle Sam out of your pocket. All right. So let's discuss the first one here. So the first one here is your HSA, which is your health savings account, and your flexible spending account. Can both be useful. All right. But they are different. And a lot of people get these mixed up, and so I want to break down the difference between the HSA, which is the health savings account, and the flexible spending account. All right. You can both use these for health related expenses. That's what it's both are used for. Both of them lower your taxable income, which is your pre tax contributions. But here's the biggest difference, though, between these two when it comes to pre tax contributions. With a FSA here, you can use about over $4,000 to put in your, I'm sorry, $3,800 for your HSA. I mean, for your FSA. For your HSA, you can do $4,180 if you file single, or you can do $8,300 in your HSA. I want to repeat that again. You can you can contribute $3,800 in 2024 towards your flexible spending account versus your HSA. The contributions are higher. The contributions in the HSA is 4,100 and some change if you file single, and for sure $8,300 if you file married. Now, these contributions here help you lower your taxable income. But here is why the HSA, the health savings account, is a lot better than the flexible spending account. One, you can contribute more to help you lower your taxable income. Two, any unused funds rolls over to the next year in a health savings account. Versus a flexible spending account, you have to use your money by the end of the year or you actually lose it. Now, open enrollment season is coming up. And I always advise you guys when open enrollment season come around, and I've been talking about these HSAs for a very, very long time. If you don't understand them, and we can go even further on a one-on-one, look at the HSA plan. It is a wealth building strategy. All right. So these funds, guys, in this HSA account, they roll over year after year after year after year after year. And the good thing about it is you can invest this money in your health savings account. In your flexible savings account, you can't invest that money. All right. Prime example here. I'm investing this money here. For instance, my oldest son had to get braces in his mouth. We put money into our HSA, the money is growing tax-free, while at the same time, the money and the investments that I've made on it, my money in my HSA account is invested in the S&P 500, and the money that I've earned paid for my son braces. Guys, that's the wealth strategy, man. What they're really not teaching you. The HSA is after the Roth IRA is one of the best accounts to own, the health savings account. All right. This account belongs to you. So if you leave your job, you can roll this over into an HSA with Fidelity or anyone else, and it comes with you. You do need to be in a high deductible healthcare plan. So you could be looking at those options through your particular job. And guys, here's one of the best things with an HSA account. As you see this money here, as it continues to roll over year after year after year, once you get to age 65, you do not have to use money in a health savings account any longer for healthcare expenses. So if this account here has built up year after year and is being invested, your contribution is 300,000, 400,000, 500,000. After age 65, you don't have to use this for healthcare related expenses because at age 65, you now become on Medicare. And so this account here is a retirement account now with an HSA. You can use it for any general purpose now. So a health savings account and a flexible spending account is the first method that's going to be able to help us because these are pre-tax contributions. It's going to help us lower our taxable income. Now, also, guys, with a flexible spending account, there's something called a health. You got the health side of it, and you also have the dependent side of it. So you can have what you call, which is a dependent care FSA. If you got kids, like I'm looking at Paris right about now, she got young kids. So if the young kids are going to daycare, if the young kids are going to aftercare at school, Paris can open up a dependent flexible spending account, she can contribute up to $5,000 in this dependent flexible spending account for the year, because she's gonna do it anyway. She's gonna pay for it through the daycares. But now, by you putting it in this FSA account, dependent care, the $5,000, they're gonna give Paris a credit card. So she's gonna, out of her payroll, she's gonna be having money coming out every paycheck going into this flexible dependent care flexible spending account, right? And what's going to happen is now she could pay for that daycare for the first $5,000. She could pay for it with her dependent care flexible spending card, and that's going to give her a tax deduction for that. All right. So you have your health side of the FSA and you have your dependent care side of FSA. Now, one caveat to this right here: you cannot have a FSA and an HSA at the same time. It's either or. All right. Now, my family, we own an HSA. And I recommend, if you can, if you got good health care, though, not good health care, if you got good health, I recommend an HSA. If you don't have good health, then you don't want to go with the HSA because it's a high deductible healthcare plan. All right. So let's go further. The second one that's going to help us lower our taxable income is our 401k, guys. If you're in the military and you work for the federal government, it's your thrift savings plan. Or if you work for the government, state government, you may have a 457 or a 403b plan. They're all 401k plans. As long as in your 401k, those contributions are pre-tax dollars. All right. You have two options. There's a pre-tax and you have a Roth 401k option. The pre-tax options lowers your taxable income. All right. So let's say, for instance, somebody last year had $3,000 they had to pay back to Uncle Sam. Instead of paying back $3,000 to Uncle Sam, you now put $3,000 more this year towards your taxable income. All right. And you do it pre-tax. You do the pre-tax contribution. And now what helps with that is if you get paid 24 times a year, hey, look, that might be only about $100 and some odd dollars per pay period that you have to pay. And now you're paying yourself versus paying Uncle Sam, because the pre-tax contributions, it helps lower your taxable income. All right. So guys, if you have to pay back Uncle Sam, I'm going to tell you right about now, through these 6 steps that I'm about to give you, if you have to pay back Uncle Sam, it's your fault. It's your fault. I don't care how much money you make. If you have to pay, I'm gonna stop this video here. Let me speak to y'all really quick. If you have to pay back Uncle Sam through your taxes, it's your fault. I'm gonna tell you why. Because you should be on a call with me this week if you pay back taxes last year. And these 6 McDonald's I'm about to give to you, we should go to the tax plan and say, ain't no way that we paying back Uncle Sam next year, because I just gave you the first 2, getting ready to give you the four more, and as a bonus, the 7th one. All right. So guys, we don't need to be paying back taxes, right? I'll just tell you this right here. The last day that you can pay your taxes, most people believe it's April 15th, but you can actually extend your taxes and do an extension, and your deadline is October the 15th. Now, Leslie and I, when we file our taxes, we always do it at the last day because she's doing everybody else's taxes. Matter of fact, she just left to go to work to her office. Guys, I remember going to bed last year on October the 14th. And I remember Leslie telling me that, hey, look, right now our tax bill is $40,000. And we've had our income increase through businesses, things of that nature, right? And so I said, hey, I'm just gonna go ahead and lay down. You just tell me what our tax bill is in the morning, because she always worked late during tax season. I said, just let me know what our tax bill is in the morning. So of course, I get up before her and I text her. I say, hey, look, what was our tax bill? She responded back and say 0. You know why, guys? Because of these methodologies I'm about to tell you right about now, right? She didn't put in all our tax deductions just yet before I had went to bed, but she had put them all in. And guys, again, Donald Trump, there's a reason why he paid less taxes than you, because he understands the tax rule. There is a reason Warren Buffett pays less taxes than you and make billions of dollars per year. It's because he not necessarily understand the tax rules, but he got people around him, a good accountants and CPAs that understands the tax rule. So if you paid back in taxes last year, there's no reason for you to be paying back taxes this year. All right. So let's continue on here with our methodologies right here, helping us lower our taxable income. So for the ones that just joined here, the first method here we discussed here was your HSA, your health savings account, your flex spending account. The second one we spoke about was your 401k account, making sure it's through your pre-tax contributions through your 401k, which helps you lower your taxable income. Guys, 529 college savings plans. You could save for your kids' college. And at the same time, while saving for your kids' college, the government would incentivize you in certain states, not necessarily Florida, in states that have 0% state taxes. You don't get the benefit of the state tax deductions and contributions towards your 529 college savings plan. But let's say, for instance, I got a client here. I believe she's on the call now. She's out of, I want to say she was in Virginia, and she got a daughter that's in college right about now. I told her, I said, hey, look, you know, if we're going to be paying for our kids' college, let's be smart about it. You can get a $4,000 tax deduction through Virginia if you put money in a 529 college savings plan. So the first $4,000 that you're going to contribute towards the college, let's put it right here in this 529 college savings plan. And we can have it in there maybe a month, 2 months, just to show that we got a statement. We have it in 529 college savings plan. And now you take that money out the 529 college savings plan and you pay the school, you got a statement. And now this gives you a $4,000 tax deduction on your particular income. See, guys, this is what I mean right about here, right? The schools ain't gonna teach you this right here, but this is a wealth strategy right about here, especially if you're in a high income tax bracket, to be saving for your kids' college, to keep them away from paying these daggone student loans, while at the same time, this is incentivizing you and helping you lower your taxable income. I got a lot of young parents that's on here on this particular call. Xavier was on here, him and his wife, they're based out of North Carolina. If they contribute towards their kids' 529 college savings plan, they're going to get a tax deduction. Now, I put in my last newsletter last week where there's different states that show the different tax plans. You can go back and look at that as well or reach out to me. But for today's purposes, I won't go into detail in the different states. But there's probably about a good 35 states out of the 50 states based on how you file, whether single or married, will give you a tax deduction from contributing towards your kids' 529 college savings plan. All right. So for all my business owners, I look at Dewan here. I look at my man Rodney here, who just started the online surveys. I look at Kalor here. For all my business owners here, I want to break this down here to you. You have an opportunity to have a business owner retirement account. And what this does is it allows you to contribute up to $69,000 in 2024 and get a tax deduction here. So what I want to do is I want to explain this a little bit further here, right? And I want to go right up over here over to Fidelity. And I want to show you guys this particular account and how it works right here. So if you're a business owner, you can also, here's the cool thing about this, guys. You can also, if you have a regular job, you can have a 401k account and you can have a business investment account if you own a business as well. All right. So what I want to do is I want to go down here and I want to look at what we call the SEP IRA account. These are for a business owner in itself here, right? So I'm going to go right here. I'm going to hit save for retirement. And then we're going to show what the SEP IRA does, right? So your contributions towards your SEP IRA, let me just find this really quick here. Let me explain this here to you. Guys, if you have a business and you have a SEP IRA, all right, your SEP IRA, every contribution that you make towards it, and I'm going to get ready to show you that here in a minute, it's going to allow you to have tax deductions for your contributions. So let's say, for instance, you got a business, all right? And in this particular business, you make say $4,000 a month. All right. out of that $4,000 a month, let's say, for instance, you might want to contribute $500 per month towards this SEP IRA account. Now, what this is going to allow you to do is that's going to be a $500 tax deduction, while at the same time, this money is also going to be growing for you at the same time here. All right. Now, I have it here. I want to show you guys a little bit further into detail what the SEP IRA here does, right? So your SEP IRA, retirement savings for the self employed here. Very, very good account here. No account minimum, no account fees here. This account right here, it helps self-employed individuals and small business owners get access right here. It's the key thing to tax deferred benefit when saving for retirement here. So when you look at this right here and you look at this right, here's the important thing right here. Your contributions here are tax deductible. All right. And you can contribute up to $69,000 in 2024 here. So you can either do up to 25% of your compensation or $69,000 here, right? And so that's what I like about this account right here is because you investing and growing your money in your particular business, while at the same time, the contributions that you're making towards this account is helping you lower your taxable income. All right. All right. So that's what a SEP IRA is. The fifth one, guys, and this one right here, I've done some classes on this before, but many of you guys don't know about this particular account. It's called a donor advised fund here. So this is a charitable contribution account. All right. And I'm going to show you here in Fidelity where you can open up one as well. But anytime you want to contribute to a charitable organization, in particular, if they're a 501c3, where if it's a university, where if it's a nonprofit organization here, right? If you open up a donor advised fund and you put money into this account, what happens with this account, money you put in this account is to be invested. And as that money grows, you can contribute your dollar that you contribute and the earnings that's earned on this particular account to any charitable organization. And guess what this does, guys? It gives you a tax deduction. So let's say, for instance, right, your church, if you're tithing, that is a charitable organization. So instead of giving you your money tithing directly to a church, you can open up this donor advised fund. You could put money into a investment account, and all of them are generally like index funds on this donor advised fund, right? They don't allow you to do single stocks. It's generally like funds that you would see in your 401k, like an S&P 500 fund, for instance, right? And your S&P 500 is up 13% this year. So let's say, for instance, you put money in here weekly instead of sending it directly to the church, and now the money that you would have been contributing to your church is up 13% this year. What it does is this donor advised fund, it takes it and you just advise them whenever you want to take money out to this account, they will send it to your charitable organization. And then that way you would get a tax deduction. You would get a 1099 at the end of the year on this charitable organization here. So not only, here's the thing I like about this here, not only are you contributing your regular money, but any interest that you earn on this money, you can send it to the charitable organization as well. Now, you only get a tax deduction on what you contributed, but you can even give your church or your charitable organization even more money from the money that you've earned on the account here. All right, guys, this right here is what the wealthy do. In order to shelter their money, in order to, this is why you have these big donors here, right? I'm talking about these big, big mega donors. They will send money to schools like these big universities like Florida State, University of Florida, Harvard. They will send money into these particular accounts, right? And what it does is it gives them a tax deduction here. I'm sorry, I have my video. It gives them a tax deduction. All right. That's the most important thing right here. So you find schools like, say, hey, look, you earned some great amount of investment return, and you don't necessarily want to have to pay taxes on all these gains, and now you want to contribute to a charitable organization of your choice and help support that particular school. Now, you don't have to pay taxes on this money, and that's going to help you lower your taxable income. Let me give you a wealth gem right about here. I told you guys this here, right? Let me give you a wealth gem. Imagine if you open your own nonprofit organization to go to some type of initiative, right? That's going to help your particular community. So you open up a nonprofit organization. Y'all see where I'm getting ready to go? And now you contribute your own dollars to this non-charitable organization, but instead of contributing to the non-charitable organization, now you put it in your donor advised fund, allow this money to be growing, right? And now you get a tax deduction, while at the same time, if you got an S&P 500 fund, it was up 25% last year, it's up 13% this year, right? So there's now this money is steadily growing. So not only are you just giving money to your charitable organization, but now you're able to give more even beyond, because now these investments that you're investing is growing over time, right? So if you're in a position where you're making, for instance, right, $250,000 and more, one of my methodologies I'm telling you is you need to open up a nonprofit organization account, right? For yourself, for your initiative, make it a 501c3. We help you with all this good stuff here, right? And guess what? Now, here's what you're able to do. You're able to make contributions towards this account, right? And now you're able to help lower your taxable income. And what most people don't realize is once you have a nonprofit organization account, you now have a president, a vice president, a treasurer, and a secretary, right? And those individuals, you could pay them through your nonprofit organization. You could be your president of your nonprofit organization. You could be your secretary of your nonprofit organization. You see where I'm going? That's what the Donald Trumps, that's what the Warren Buffetts, that's how they know and understand the tax law, because all they're doing is just recycling the money back to them, but it's putting it through a vehicle, right? That's been able to shelter their money, and it's legal. That's the crazy part about it, but we don't know and we don't understand it. So a nonprofit organization and having it through this nonprofit donor advised fund is very good here. So this is what it looks like right here into Fidelity, right? This is what it looks right here. Fidelity charitable giving account. There's no minimum to open. All right. So when you kind of go right here, you look at it even a little bit more here, right? How does a Fidelity charitable giving account works, right? So you give, potentially given to a qualify for a tax deduction. You generally want to give it to a 501c3, right? They have these different nonprofits that's in here, right? The account is going to be growing because you're going to be investing in some type of accounts. They have about 15 different options that you can invest in here, right? Your contributions are invested based on your preferences. So it has the potential to grow tax free and can unlock additional charitable dollars while you decide which charities you want to support, right? And here it is right here. This is where you grant it, right? This is where fidelity of your charitable organization, where they will send it to, right? Because a Fidelity Charitable Giving Account is a donor advised fund. You advise us on granting the money to your favorite charities, a la your church, if you wanted to, via your tithes. Now or over time, you can do it weekly, you can do it monthly, you can do it quarterly, you can do it annually. You can even do it to your local food bank. I mean, guys, a lot of people don't know about this account, but this is a wealth gem. All right. Smarter way to give, smarter way to lower your taxable income. All right, we're gonna take some questions here at the end here. But our fifth one here was the donor advised account. And the sixth one, guys, and the most important one here, right, is real estate. Whether it's your primary property or whether it's investment properties, one of the biggest tax advantages that you're gonna have through real estate is called depreciation. I'm gonna break that down here for you a little bit. But even if you own a primary property, your interest that you pay from your loan that you have with the mortgage, that's tax deductible. Your property taxes are tax deductible. If you have investment properties, all your repairs, all your expenses, anything that you do when it comes to your real estate, grass cutting. I mentioned that on an Instagram story this week on the Let's Win Financial Group page here, right? All the grass cutting. My cleaning ladies come every other Tuesday. I pay them. That's a tax deduction on the properties. Pest control services, air conditioning services on an investment property, not your primary property, because that's not your business. But on your investment property, all of those repairs and expenses are what you call tax deductions in itself here, right? I say this right here. I'm gonna go into the depreciation here. I say this all the time. Most of our real estate properties are in where our family lives, like where my brother or maybe where my sister live, right? And so every time that I go and see my family, to me, I call it a business trip because I'm able to claim the mileage, right? And so we're going to talk about that in a minute as well. So that's going to be able to show you it's you get 67 cents per mile as a business owner when you're traveling. And so when I'm going to see my family and these rental properties, that's going to be 67 cents per mile that I'm able to deduct when it comes to being a business owner, in particular through real estate in itself here. All right. So guys, I'm getting ready to break down the depreciation to you guys. And I want to share my my screen when it comes to rental property depreciation and how that works in itself here. So let me share my screen here and kind of break this depreciation down because one, guys, this is why a lot of people own real estate. And to be honest with you guys, this is why 90% of millionaires own real estate because of this one particular wealth gem right here. All right. Now, you will see right here where it says, I just put in here right here, real estate depreciation for 27 and a half years. So you can depreciate not your primary home, your real estate investment property. So Dewan, when you file your taxes on your investment property, you have 27 and a half years to deduct it. I'm going to show you the calculation here on how you can use this depreciation to deduct it from your taxable income and why it's one of your biggest tax deductions that you're going to have through all these different methodologies that I just went over here, right? So let's say, for instance, here, right? They say that we have 27 and a half years to deduct the real estate property here, right? So here's what I'm going to do. I'm going to go right up over here, Dewan, and I'm getting ready to give you an example here of how you can have this big deduction right here. All right. So let me break it down right here. So Dewan, let's say for instance, right? Let's say for instance, you bought your house, your investment property. Let's say for instance, you bought it for say $400,000 here. All right. Now, if you go and you look on your property appraisal website, you're gonna have what you call the building, and then you're gonna have the land for as the value wise, right? Value. I'm gonna put so building value. All right, building value, and you're going to have land value. All right. Now, when it comes to depreciation, you can't get the value of what the land is only on the building. So if the one bought this investment property for $400,000, let's say the land value was 50,000 and the building value, let's say for instance, is $350,000 out of this $400,000 here. Here's what Dewan is going to be able to do each and every single year when it comes to depreciation here, right? So Dewan is going to be able to go over here and take this $350,000 here, right? This building value of $400,000 here, right? And because the government says that you can depreciate your property for 27 and a half years here, we're going to take this $350,000 here, and we're going to divide it by 27.5. All right. When we take this 27.5, guys, this is a wealth strategy. This is a wealth strategy here, guys. This is $12,727 that Dewan is going to be deduct from her income that she make on her real estate property. Not to mention with all of the repairs, expenses, flying, trips, whatever you're doing with the property, right? But this is going to be one of your biggest deductions that you're going to be able to take advantage of. Imagine if you had two properties. Imagine if you had three properties. Imagine if you had four properties, right? Any investment property that you have, not your primary property, your investment property, you're going to be able to depreciate that particular property and lower your taxable income. Here's the thing that I love about real estate. Real estate, you can make a ton of money, but you can show that you have a loss on paper because of depreciation. All right. Now, we can go into detail on a one-on-one, but that's another way here, the way we can lower our taxable income when it comes to real estate. All right. So if you don't own any property, right? Like if you're just renting, that's going to be very tough on you because now we can't take advantage of interest and property taxes to help us lower our taxable income. All right. So while it's going to be important, be in our class on Thursday with Miss Ebony Ferguson to help us how to buy a property if we don't own real estate. All right. Now, guys, so this is the last one here, number 7. All right. Now, what we've done is we went over 7 different ways to where to help you, or 6 different ways to help you lower your taxable income. The first one was through a health and savings account and a flexible spending account. The second one was through a 401k account doing pre-tax contributions. The third one was doing through a 529 college savings plan, saving for your kids' college. And there's about 35 different states that actually give you state tax deductions. The states that do not have state taxes, like Florida, Vegas, Tennessee, those states that don't necessarily have tax deductions, they don't give you this incentive, right? But if you're in Virginia, Maryland, Alabama, Georgia, you get a state tax deduction. In particular, for instance, we use an example. If you're in Virginia, if you file single, you can get a 4,000. You can contribute up to $4,000 in the 529 college savings plan and get a state tax deduction. If you married in Virginia and you file married, you can get up to, if you contribute $8,000 in the 529 college savings plan, you can get an $8,000 tax deduction. Number 4, we talked about a SEP RA with business owners, right? Taking some of your business income and now sheltering it into a investment vehicle, and every dollar that you contribute up to 25% of your compensation, or 69,000 2024, will give you a tax deduction. Number 5 here, the donor advised fund, contributing to a charitable organization through Fidelity, through the donor advised fund. That money now is growing tax free as you invest it, and you choose your charitable organization of choice, and Fidelity will cut them a check, send it to you on your behalf, and at the end of the year, you get a 1099 statement, and your contributions that you contributed will give you a tax deduction, and the investment returns you gain on this particular account, you can give it to your charitable organization tax-free. Wealth gem, guys. And number 6, we talked about real estate. But number 7, can anybody tell me what number 7 is? Just a wild guess. I want you to unmute. What's the last one? And this is the most important. Anybody unmute?
Hello.
Yeah.
It's me, Rodney.
Yeah.
I'm just gonna take a wild guess because I haven't heard you talk about you've talked about the Fidelity counts, but is the Roth IRA involved in that?
Nope, because a Roth IRA, remember Roth IRA, it gives you you've already paid taxes on that money, so it's growing tax free. Yeah, that's a good guess though.
And then I'm stuck then, man. If you've mentioned
Rodney,
it
and
before, I'm
Rodney,
stuck,
you
man.
got
I'm
So how
you
stuck,
about
got
man.
this.
maxing out your Fidelity?
Huh?
How about maxing out your Fidelity?
What you mean maxing out Fidelity? Fidelity, you got a bunch of accounts.
Put the max account. What is it? 12 grand.
Yeah, so but that no, that's I mean, because you talking about your Roth IRA. We kind of already
Investment
talked
account.
about investment accounts, right?
Okay.
Guys, there is one that I have not talked about that see Christina mentioned maxing out TSP, that pre-tax that helps lower your tax income. We talked about that through the 401k. But guys, there's one mythology.
No,
It's
but
huh?
have you talked about it? I'm just curious, man. I
I
mean,
have not talked about it. And
okay.
Rodney, you got it. You just started it.
I did.
Yeah.
Oh, oh man.
So Christina, you right there on the surface, but you ain't quite said it. But your comment that you just made, you right there on the surface. Rodney, you just started one 2 months ago.
Oh, 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 own your own business.
On your own business. That is the 7th one, guys, to help you lower your taxable income, right? Owning a business owner, right? Helps you lower your taxable income. now you have over 300 different tax deductions that's available to you as a business owner versus a person that has a W-2 and works for an employer and gets paid through an employer versus if you're a business owner. Now, man, you got all these different tax deductions that's available to you. All right. I'm gonna show you here just 99 different tax deductions, but you can have a 9 to 5 job and you can own a business. I do it, right? And that's one thing a lot of times what it stops and prohibit people from doing what they need to do. But you always hear me say this terminology. You can work a 9 to 5 and you can work a 5 to 9 when you get home. Instead of watching Netflix, instead of being on your Amazon account shopping, right? You just go and work the business from your 5 to 9. Now, let me just share here with you on 99 different tax deductions that you could take advantage of by being a business owner. All right. Now, this is also too on our Facebook page through Fidelity as well. All right. Not I'm talking about Facebook page through Fidelity. This is on our Let's Win Financial Group Facebook page. All right. Now, accounting fees, consulting fees. So check this out. Guys, anybody that's a member of the Let's Win financial community and you got a business and we talking business and you paying a monthly subscription, that monthly subscription now is a tax write-off. You understand that? Membership fees that you have for your business, any equipment repair. I can go through all these here. Depreciation, we talked about that, right? But here, guys, are 99 different deductions that's available to you to help you lower your taxable income. That's not available to you if you just work for a company as a W-2 employee. But now, as a business owner, the government says, hey, look, here is 99 different deductions that's going to be available to you. So by you guys working as a W-2, your Wi-Fi, you can't write that off. But if you're a business owner and you have some type of business, Rodney just opened up a online survey business, helping people make additional income. Before Rodney had this business, he always had Wi-Fi, but now that he got his business, he can write off his Wi-Fi, his internet they're using to help other people, right? Any equipment that Rodney buy, any insurance that Rodney buy. Rodney can also be able to utilize a home office deduction write-off. Man, guys, all these different tax deductions. Rodney needed storage rental for his business or any office supplies. Hell, if Rodney decide, hey, I'm gonna go and buy an iPad for my business, or I'm gonna go buy a MacBook for my business, right? Guess what? It's off. He gonna use it for personal use too, but it's a write-off. All this stuff right here, guys. I mean, we got people here in business that's paying like rent. That's a write-off. If you need your business and it need to have a rental space, that's a write-off. All right. These are 99 different tax deductions that you can take advantage of as a business owner here. All right. Now, what happens is you guys can go over to the Facebook page on the Let's Win Financial Group page under files and get this here. All right. Now, 99 different tax deductions as a business owner, guys. That's why I'm telling you. That's why I just told you about 15 minutes ago, 20 minutes ago. If you paying back in taxes next year, is your fault. Because there ain't no way through these methods that I just gave you that you should be paying back Uncle Sam in taxes, right? Matter of fact, we're going to be sheltering this here and putting in different accounts, and you hiding your income. And it's look, it's legal because it's the tax rule. Uncle Sam, Warren Buffett, Donald Trump, they understand that. Check this out though. Let's talk about this here and then we're done and we'll take some questions. So we talked about the business value. I mean, we talked about depreciation real estate, but when we go back right here and we look at this wealth gem right here, guys, this right here is the greatest wealth strategy that the government created for a business owner. And you see it on social media all the time, right? If you're on Instagram and TikTok, right? This right here is the biggest wealth strategy that you can ever create. So here's how this works, all right? Here's how this works. So you basically, let's use an example here, right? We're gonna come back right here, but let's look at this here, right? So hire your kids as a business owner. So let's say, for instance, use an example here. Sally makes t-shirts, all right, for the community, for the church, whoever. But she has a business where she makes shirts, all right. and Sally has a 7-year-old son. All right. Now, Sally makes about $3,000 per month, for example, doing these shirts. Right. Now, what Sally does is, right, Sally can pay her son up to $14,600 in 2024. Does anybody know this particular limit right here? This 14,600. You know what this is? Does anybody know what this is? What this called? If you don't, that's why you're here. It's called your standard deduction for 2024. Everybody get a standard deduction. All right. So IRS says that you can pay your kids up to the standard deduction, whatever that is for that prospective year. For 2024, it's $14,600. Right. Now, generally, it's really not in the books, but they say if your kid is a minor, up to 18. But if you got a spouse, you can pay your spouse up to the standard deduction as well and get a tax deduction. In this example here, you could pay your child up to 14,600. I don't necessarily recommend that. But let's say, for instance, right, whatever she pay this amount is tax deductible, whatever she pay her son. All right. Now, what you want to do right here is, as a business owner, what Sally want to do is she want to document her son tasks, whether he's cleaning the office, he doing marketing on social media and helping her post different things about the shirt business to drive in more traffic and business, whether it's on Instagram, whether it's on TikTok, whether he's going with her to community events or conferences, all these different tasks right here. She want to document it every single month, the task that he's doing. Now, one thing what the government says, if you're doing this right here, the paying what you pay your kids need to be ordinary and necessary. Those are the two key things here. Ordinary means you can't necessarily be paying your kids $250 per hour on the task. That ain't ordinary. Ordinary is $25 per hour, $30 per hour, and document this here. So if this kid is doing 10 hours a month and $30 hours at $30 at say 10 hours a month, that's $300 a month. That's ordinary and necessary for you to run your business. All right. So all these tasks right here, you want to be documenting it every single month of basically what he's doing. Have an employment agreement, setting that up and saying, okay, look, we're going to pay you $30 per hour. You're going to work 10 hours per month. And then now that money is going to be coming from your business account and going to that particular child's checking or savings account. You want to structure that and show that from your business. And then once you do that, you want to take this to another step here. Then you want to, now here's what this happens though. Just paying your kids from the business account to their checking account gives you the tax deduction. All right. That gives you the tax deduction. But if you want to take this to the extra step, then this is what you do. You open up a kid's Roth IRA and invest the money. All right. Now, because anytime a child works and earn money, I don't care if that child 1, I don't care if that child 5 years old or 18 years old. You want to, anytime your child makes earned income, you want your kid to have a Roth IRA account. All right. Now, on Fidelity here, they have it here to where you can have a Roth IRA for an adult and you can open up a Roth IRA for a child as well. If you go here, open account, and you go save for kids and education, and you hit apply, what you're going to see here, you'll see a kids. This is a regular kids investment account here. But where I'm going is they have a 529 account. Many of you have it here. Where I'm going is looking for a kids Roth IRA. Boom, there it is, guys. Roth IRA for kids. This is what you're going to do right here. Rodney, the money that you're making in your business, brother. You go and you saw that young daughter that was on here before everybody joined in. She helped you in your office. You're going to open up this right here, an account for her, because she's going to help you clean out that office. She's going to help you run your business. We're going to open up this account right here. You pay her, you get a tax deduction. A Roth IRA kids account is a tax advantage retirement account. That baby that you got right now, I don't know how old she is, but I see she a young baby.
Yeah, she's 6 years old, and that's my granddaughter, by the way.
Oh, your granddaughter. Oh, Rodney, you telling your age, brother. I didn't realize you had grandkids. You look like a young man, brother. Jeez. So, all right. So, yeah. All right. So you got kids, bam. Your kids can have a Roth IRA, guys.
But my youngest daughter does have a Fidelity account.
Yeah, that's good. That's good. That's good. So, guys, what I'm telling you is, man, most people, man, I talked about this on the Facebook page, right? Most people don't take advantage of an opportunity that's before them. All right. Now, most people, before they meet me, they don't have no Roth IRA account, and they in their 30s, they in their 40s. Now you got an opportunity if you got any type of business, or you might think of some business and you just start earning some income. This is one way that can help you to lower your taxable income. All right. This is very, 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 very important here. Now I'm gonna share this here, and I am really, really done. All right. I talked about taking advantage of opportunities that's before us. All right. This right here is what I posted on the Let's Win Financial Group page last night. Don't let fear rob you of your financial future. Take advantage of it. 4 years ago, while people was buying toilet tissue and scared of COVID, and God bless the people that passed away, that was a very scary time for us. But the one thing, guys, that I knew that I had to do was take advantage of an opportunity. Because when I saw mortgage interest rates go down to 2%, and since I've been living and been an adult, I've never, ever, ever seen interest rates this low. You guys probably heard this story before, but I told my wife, I said, look, it's a prime opportunity for us to go buy some real estate property. At first, she wasn't on board, but I was still going looking at houses until she got on board, right? And eventually, she just started going with me. We bought an investment for $340,000. Guys, it was listed for $380,000. We was about to spend $380,000 until the appraisal came back and it appraised at $340,000. So we was about to pay 380, we paid 340 for it, and 4 years later, it's worth $210,000 more than what we paid for it. It's the same way, guys, in the stock market right about now. And I mentioned to you, and I'm done with this here. September is a very volatile month historically. So you're going to see volatility this month, but never change a long-term strategy due to a short-term consequence, because September, trust you me, is very, very volatile historically. But like it always does, guys, it always comes back up. So don't get emotional. Do not let fear set in. We're going to be okay. Matter of fact, they probably don't even look at your account if you don't want to. But guys, for me, when I see an opportunity, I see blood on the streets. When others get fearful, you get greedy. That's what Warren Buffett said. So for me, when I see opportunities now like NVIDIA at $102, and if NVIDIA even go down even further at $90, look, guys, this is an opportunity to cash in. The same way I bought that property for $340,000 4 years ago, and now that property is worth $550,000, and I paid $340,000 for it, right? And guys, I don't owe 340. I owe like 210,000 on it. So I got over like $300,000 in equity from a decision I made when other people was having fears about COVID and all this other stuff and worrying about trying to get a check from the government. I'm always 2 steps ahead of the game. And I'm telling you now, we got discounts in September. And people freaking out and panicking, calling me saying, should you sell it, an investment? Sell it? Hell no. We need to buy more because it's an opportunity for us to capitalize on. That's what we have to understand. We have to understand to capitalize on opportunities. But for us, what we do is we don't understand money, and these are assets that's actually going for us. We spend money every single weekend on going to Red Lobster, Chick-fil-A, and all this other stuff where it's not going to give us a return. And we don't think about that as actually money that we're actually losing for us taking advantage of these opportunities that's before us. That's why I want to encourage you guys and keep you encouraged to say there may be some more volatility in September, but never change a long-term strategy due to a short-term consequence, because the market is up 13% this year. We're only 4.7% away from the market being at an all-time high. Interest rates getting ready to get cut September 18th. We're in a presidential election. I can guarantee you, I don't say guarantee, but more than likely that market gonna go back up at an all-time high by the time the first week in November. And most people sell out. I don't say most people, not people in the less win financial community, uneducated people, right? They'll sell investment because, oh, NVIDIA went down. why are you selling when the video go down? That's the prime opportunity to buy more. All right, I'm on my kickbox. I'm done. But this is, guys, 7 ways we went in helping you lower your taxable income. All right. This is also recorded. I'll take some questions if anybody have any questions on anything I discussed today or financial questions. Period.
Yeah, sure. And I do have not a question, but no, it is a question. Are you able to email me that list of the 99 deductible thing? Yeah.
Hey, Rodney, I'm gonna do you one more solid. You can
What?
actually can go right over here to this Let's Win Financial Group page right here. I'll
uh,
email it to you as well. But for the ones that's on here, you can go right over here to Let's Win Financial Group and you go right here to files. And
Oh,
once you go right here to files, you go right here, 99 different tax deductions. Boom, it's
oh,
right here.
oh, thank you, sir.
Yep. Any templates, overall monthly views, right? I'll get this update as well. Ways to lower your taxable income. We went through some of these days. You go right over to files and pick it up.
Gotcha. Thank you.
Yep. My
Hey,
pleasure.
Sharon, this is Tasha.
Tasha, how's it going?
Good, good. So, like with my income, I'm currently just all I have left is my daughter being in college. Like
Mhm.
I'm concerned, like in a couple years, I'm not gonna have any deductions. My house is nearly paid for. Like even with that, I'm not getting a whole lot of home interest,
Mhm.
for my
Mhm.
deductions. Should I look at like buying a house? I mean, my job, I travel too much, I feel like, to start a business, but
Mhm.
I'm just kind of thinking long range here. Is that something I should be looking for towards, since I already have one property, but it's not really giving me a lot of deductions at tax time. Like, what should somebody do like when their children are no longer under 18 and they're single, but their income is a little significant to are you saying like one of those 7 strategies, either like start your own business or buy another house? Are those the kind of things that I should be looking into right now?
Yeah, so another thing too, Tasha, like if with the income being high, right? And so I would encourage people to increase your 401k as well, right? So if you have less deductions that you can take advantage of as your income continue to increase your contributions towards your 401k because it's going to help you lower your taxable income. Now, the one thing here, IRS says for 2024, if you are under the age of 50, you can contribute up to $20,000 per year. Under age 50, $23,000 per year. If you're over the age of 50, you can do what we call a catch up, and you can do up to 30,500. So in your particular case, Joshua, you don't necessarily have the kids any longer, right? In the houses, we just need to be sheltering that money either in your 401k account. I would highly recommend you can open up any business. They don't have necessarily have to take your time. Maybe look at an investment property, or do that organization account. And that's something I think would be great for your family in honor of your dad as well. So we can discuss that whole wealth strategy plan there, right? Setting up that nonprofit for in honor of your dad. All right. Any more questions?
Good morning. This is Nicole. I have a question.
Yes, ma'am.
For the donor advised account, is it better to contribute to that account than when we just pay our tithes to the church? How like I cut a check to the church every time I get paid. Do you have more of a tax deduction if you set up the donor account?
So your tax deduction will be the same, but you will be able to, depending on the market, to be able to give that charitable organization more money for say it's right. If you gave your church regular, say for instance, $10,000, right, and the market was up say 15%, that's additional $1,500 on top of your $10,000 that you're able to give your church through those charitable so it really depends on your situation, right? If you're comfortable with it, because the money is invested. But that's one of the strategies that we use when it comes to contributions for our ties and how I do it with my family. But yeah, I say recommend it. Let's try it. You don't have to do all your tithing, but you just kind of see how it works, right? So put a couple $100 in there, maybe $1,000 in there, and then set that donor advised account up, watch it grow, and then you can see how Fidelity can send that money directly to your church.
Okay. Thank you.
Yep. Any more questions? All right, guys, it's been good. We're right at our hour mark. So thank you guys for joining in. This will be recorded on the YouTube page as well, and can be sent back out to you guys. And so we'll ensure that you get it. And hope you guys have a good continued weekend. And as always, be blessed and let's continue to win. All right, guys, have a great one.